75,000. Do you agree with some other people I spoke to that it's not really going to be a market mover unless we see an outsized move either to the upside or the downside? Because I think most people think that cut is nearly a certainty. I don't want to say it's a certainty, but pretty close to a certainty.
Yeah, unless the world falls apart, and falling apart is going to be putting numbers that are way beyond that $15,000, $20,000 margin of error that we're talking about. Because the quality of data, as you see, has been so bad that we really look at the revisions to see where the real data are trending. But without a doubt, the Fed's new framework tells us that it's not just the unemployment rate that the Fed cares about. It's not just the employment numbers. It's going to be a whole, a complex of numbers that deal with the labor market that they are going to use to evaluate whether it's weak or not. And surely all the data we've seen so far is that the labor market is weakening without a doubt.
Wait, Bill, I want to be clear. So you're saying that the Fed's not just focused on jobs? Because when we heard from Jay Powell, it seemed like it was really focused on jobs. He goes, yeah, PCE is going to be 2.9, but we're not worried about it, and kind of struck a dovish tone. I mean, 2.9 is considerably higher than 2%. You don't have to be a math major to know that. So it doesn't seem like to you that it's all about the jobs numbers? What's the other?
It is about the job.
Okay, I think there's some other things in there.
But there's not just the unemployment rate, right? The JOLTS numbers, openings are important. The ADP numbers are important. So it's not just the unemployment rate that the Fed used to focus on. And that's what the important thing about the new framework is that it gives them a lot more flexibility to decide whether or not the labor market is weakening.
All right. What are we seeing in the bond market? We saw bonds actually move lower yesterday after that ADP report. Some people think it's kind of like a Goldilocks number. It was soft and it leaves the door open for rate cuts. But shouldn't that be a concerning sign if you're an investor either in the bond market or the equity market?
Not at all. In fact, if the fact that the employment numbers are coming down to sort of a steady state, that's something that allows the economy to hum along at its trend growth, which is about 1.125%. That's exactly the kind of thing that bond markets really love. Despite the fact that we have overwhelming deficit numbers out there, the fact that the economy is not going to overheat and inflation is really not part of the picture right now. All
right, let's look ahead. We have an inflation report coming up with CPI ahead of the Fed's final decision. How much weight should be on that? And I know you're not really a market voice here, but how do you see just the economy or the markets moving between now and then? I mean, do you think bond investors are going to be anxious in between now and that CPI report? Do you think equity investors are going to be anxious? I mean, how much weighting is really on this report?
Once we get over the employment hurdle, we have to look at the other part of the Fed's mandate, which is price stability. And if the CPI numbers come in relatively tame and it doesn't show a lot of increases because of tariffs, in fact, there's going to be a lot of offset because of lower energy prices. So I think as long as the CPI contains that declining trend down to the Fed's 2% target, the market's going to be overwhelmingly happy.